Good morning, it's Jeffrey Christian of CPM Group. It's about 11:40 in the morning on Friday, the 6th of January here in New York. It's the Feast of the Epiphany for people who grew up in the Western Christian churches. And the 6th of January has taken on other meanings, and it is sort of an epiphany because it has been demonstrated to us on January 6th how fragile democracy is around the world, including in the United States. That said, I have a lot to talk about today. I'm going to be talking about things that are going to be affecting gold and silver today and in the future. I've been asked to talk about employment. People say, talk about inflation and interest rates a lot, but what about employment and its effects on precious metals? Well, we saw that this morning. The December jobs reports, both the household and institutional reports came out from the Bureau of Labor Statistics, and they showed a strong economy, 223,000 new jobs created, 3.5%. Markets were kind of disappointed in some ways because it was only 223,000 jobs created in December. There's usually a spike in temporary jobs, often in retail, in December each year as companies hire seasonal workers for shops. Given the transition away from brick and mortar stores to Christmas shopping online, there has been perhaps less of a seasonal hiring in December of this year than there has been in years past. Excluding that, it's a pretty strong jobs report. The markets didn't necessarily take it that way. They said, oh, this is kind of weak. And as a result, you've seen gold and silver, platinum and palladium and other commodities move upward predicated on the concept that with such a weak jobs market as only 223,000 jobs being created in a month in the United States, that the Fed would have greater scope to stop raising interest rates sooner. This is this pipe dream of the pivot that you've heard gold bugs and gold promoters talk about for a year now. The Fed is going to be forced to pivot and lower interest rates starting immediately or soon because of the weak state of the U.S. economy. And in fact, the Fed hasn't pivoted for a year, and probably the Fed will never pivot per se. As we've talked about in the past, and I'll talk about in a second, interest rates probably going to plateau before they start declining. But we'll get back to interest rates later. So employment can have an effect, a knock-on effect on precious metals because the employment statistics and perceptions thereof and analyses thereof by the Fed and the Treasury and others can affect attitudes toward financial markets, from stocks and bonds to precious metals. Given our expectations of the economy and our interpretation of the employment data, we see today's spike as something of a temporary type of thing, and we'll expect precious metals, gold and silver prices to pull back early next week. They're not going to go back to much lower prices, but they'll probably go back to the range that we've seen in the last couple days. Interest rates are facing an interesting thing. You're seeing this divergence or discussion of the divergence of opinions about interest rate trends, and that divergence, and CPM Group has written about it and spoken about it too, may not actually exist. Insofar as there's a divergence, it's more about when the markets think that the Fed will reverse its policy or change its policy of rising interest rates. The Fed has been very clear, and markets ought to believe the Fed, and I think for the most part mainstream markets do. And the Fed has made it clear that it sees inflation as a problem. It doesn't see the inflation going away anytime soon. No one in their right mind expects 2% inflation in the United States by the end of this year. The consensus is closer to 5%. I think the Fed is probably thinking that they'll be lucky if they get down to about 5% by the end of this year. So the Fed's view is that it is going to have to keep raising interest rates, at least for the next couple meetings at the end of July, beginning of February, and then again in March, and then maybe plateau. And any decrease will be small and much later. The consensus in the mainstream market is that you might see 25 bip declines in November or December of this year. The Fed has been sending out emissaries to suggest that interest rates may actually rise a little bit more, and they may stay higher into 2024. So I think that insofar as there's a divergence, what you're probably seeing is a divergence of the view as to how weak the economy will get and how soon the economy will get, and thus when the Fed may actually start lowering interest rates. I think that what the yield curve is actually telling us and telling the Fed and the markets is that you have a lot of demand for credit right now because you've had a relatively strong economy for the last 6 months in the United States and a surprisingly stronger economy in Japan, Europe, and the UK than a lot of people had thought. And it's continuing to be strong in the first quarter of this year. So that said, you're seeing higher short-term rates, and that's actually where Fed policy works. The Fed funds rate, Fed's policies are affecting short-term rates. Longer-term rates are lower because everyone that is rational is looking at the state of the world and state of the U.S. economy and saying, okay, things are halfway decent now, but they may not be halfway decent a year or 2 or 3 years from now. So the demand for borrowed money may be weaker on a longer term basis. Also, because of the rise in interest rates, you're seeing borrowers more interested in short-term borrowing than longer-term borrowing. So we don't necessarily see a divergence in interest rate attitudes. We see impatience on the part of people who have been saying, oh, the world's in much worse shape than it really is, and the Fed is going to have to pivot for a year, and they've been wrong. And rather than say maybe the market's right, interest rate levels are right and indicative of what things are, and I've been wrong in my, if not analysis, my beliefs. Therefore, I am impatient for waiting to see the Fed lower interest rates. All of this ties into this whole issue of recession probabilities. Mainstream economists now, about 65% of them in some surveys, suggest that we could see a recession in 2023. And many of them are now talking about, well, maybe the second and third quarters, or maybe the third quarter, or maybe the fourth quarter for the start of a recession. Many other economists are expecting a recession possibly in the fourth quarter of 2023 or in 2024. That's been CPM Group's expectation for some time now, and it continues to be. All of that leads us up to the dollar. And I put this up here, on the right-hand side, you can see just over the last 5 years or so, the increase in the dollar from the beginning of 2021 to third quarter of 2022, and the decline in November and December. And this puts it in perspective. We're back down to the highs that we saw in early 2020 at the beginning of the pandemic, when everybody was saying, however the pandemic and the lockdown shakes out, it's going to be worse for everybody outside the United States than people who are in the US dollar. And it's far higher than it was prior to the pandemic and lockdown and at the start of the economic recovery in early 2021. The right-hand chart shows you on a longer-term basis the strength of the US dollar relative to its historical performance since it was free to float in August of 1971. So dollar's not crashing yet. Sorry for those who are impatient for it. I wanted to address the ruble. We see a lot of crazy comments, and one of the strange things you see is that some gold and silver bugs and promoters are going out of their way to be apologists for the Russian government, simply because the Russian government is fighting a proxy war with the United States government. And these folks seem to hate the U.S. government and the United States economy and the United States as a capitalist democratic society so much that they're willing to be apologists for the Russian government and its invasion of its neighbor, despite everything. So we saw a comment the other day in one of our videos about, hey, the ruble is at a record high. Actually, it's not. This is the ruble. It's about 1.3 cents or so, 1.2 cents. And you can see that is sort of the low that we've seen over the last 6 or 8 years, 7 years now. And yes, the ruble has been higher since 2014, 2015. And it got very high when there was this changeover due to sanctions against the ruble. That was just a spike up. It's come back down. If you ask any Russian on the streets of Russia, they're not going to tell you that they're putting their money in rubles. Demand for gold and silver coins and medallions is very strong in Russia because people who are on the ground in Russia really don't want the ruble. And frankly, other people don't either. You also heard comments that, oh, oil is being bought and sold in rubles. No, it's not. Oil is still being bought and sold primarily priced in US dollars. In many cases, the settlements are in either US dollars or euros, the majority of those transactions. And those dollars and euros are then being converted into rubles by Gazprom Bank in order to remit them into Russia, to follow Russia's wartime regulations on foreign currency transactions. So oil's not being traded that way. Also, you hear a lot of garbage about the BRICS moving away from the dollar and India supporting Russia. Europe, Western Europe last year bought 6 times as much oil and gas from Russia as did India. So when you start talking about, well, who's actually still buying gas and oil and supporting the Russian economy, Europe is 6 times more important in that factor than is India. A lot of nonsense being talked about Russia and the ruble and everything else, gold and silver included. Just one last chart on Russia. This is the Russian GDP estimates. And you can see that it's in a recession. Yeah, it's not that all that great. Putting all that together and looking at the way precious metals markets work, very often you see the highs for precious metals, gold and silver especially, but also platinum group metals, in the first quarter of this year. And we've seen gold, silver, platinum, and to a lesser extent palladium rise November, December into January. Our expectation this year is similar to what it was in previous years, which is that we could see precious metals, gold and silver at least, peak in January, February, maybe March, come off and be somewhat lower over the second and third quarters of this year, rising again in the fourth quarter of 2023, perhaps as the United States and Europe and Japan move toward a more significant and real recession. If that's the case, investors and producers ought to be hedging their gold and silver price exposure for this year. And as CPM Group always says, yes, you should be long gold and silver, and B, you should hedge. And you should hedge wisely using options. Buy a put, pay for it with a call spread. We can show you how. And we don't take the other side of the transaction, so we're not looking for trading fees. We're consultants. People hire us and pay us to get our market views correct. Speaking of market views, we now have posted on our website, cpmgroup.com, places where you can pre-order our gold, silver, and platinum yearbooks. These reviews and outlooks provide tremendous amount of recent data and analysis, as well as historic data, and a view as to where supply and demand and prices are going in 2023. So you'll find credible information about central bank gold purchases and mine production, secondary recovery, fabrication demand, investment demand, and inventories across all of the metals. Those reports will be coming out over the next 6 months, 7 months, and you can pre-order them on our website. You can also see increasingly on CPM Group's website the reports that we produce for MoneX Precious Metals and Gold Bullion International. And those are also available increasingly on our Bloomberg pages if you are a Bloomberg subscriber. You may become a retail investor client of ours. We have low price services for those. Or you may find that you want a more intense consulting relationship. You can go to our website and read all about that. Talk to you next week. Take care of yourself and those around you, and take care of everybody else in the world. Because we all are in this together, even the ones that don't realize that.